If you have joined the green finance transition, or if you are planning to do so, you might have heard about greenwashing and likely you are concerned about it. In this video, we packed the latest regulatory intelligence on the basis of a recent report from European authorities on greenwashing. As a bonus, we will also look specifically in the investment management world or industry, what are the strategies or the claims that raise flags the most for greenwashing. Let's dive in. One of the quiz of this first 2 years in Europe of the green finance transition is that there is a fundamental mismatch nowadays between the huge demand of ESG products and the real pool of available investments that have a true sustainability profile. Greenwashing kicks in because in the process of wanting to gain an additional market share, fund managers, product manufacturers of sort might want to prop up the sustainability features of their products just because they really want to get more market share. Greenwashing does exist already as a definition at European level, namely in the taxonomy regulation. It is pegged as a marketing practice where intentionally an issuer, a product manufacturer, gains an unfair competitive advantage because it presents in a misleading way some of the sustainability features of a product. The report from ESMA wants to challenge some of the core assumptions in this definition of greenwashing. Why ESMA is doing that? Because it wants to broaden the scope of the definition of greenwashing so as to have a more effective prevention of greenwashing occurrences. Greenwashing, according to ESMA, can and indeed materializes throughout the entire value chain of the sustainable investment chain itself. And it doesn't materialize necessarily as an active conduct of providing misleading information, but can also indeed occur when certain critical information is omitted. At the same time, it doesn't necessarily have to be intentional, according still to the report from ESMA, nor cause a damage to the receivers of the claim. Of course, we see that challenging this assumption helps in having a broader scope for prevention, but it doesn't really come without downsides. If we shift from the prevention to the enforcement, for instance, if we wanted to pursue greenwashing under fraud and we didn't really have a damage, we would not be able to pursue it effectively using fraud as the paradigm for the enforcement. ESMA in this report looks at the various dimensions of greenwashing. We have a dimension of the actor, we have a dimension of the topics of greenwashing, we have a dimension of the qualities, and also the one of the channels. The idea is that when looking at greenwashing through these 4 dimensions, it is possible to capture instances that before would have not been defined as greenwashing as such. If we look at the traditional concept of greenwashing is a marketing practice, right? And so only the product manufacturer, the issuer, the fund managers would be engaged in greenwashing. However, if we look at it through the dimension of the actors, for instance, the trigger of a claim that then results in a greenwashing occurrence might as well be the underlying investee company making a claim on one of their sustainability profile, or could be the administrator of a fund. And so basically in this situation the fund manager would just be the spreader of greenwashing and not really the trigger or the initiator. The receivers are always the same and are always the investors or the consumers at large. Looking at the next dimension is the one of the topics, and here it's a little bit more narrow on the claims made on impact, on the ESG profiles, the sustainability objectives and aims, and especially the engagement seems to be an area, as we will see also later on in this video, for what concerns investment management, that triggers some of the red flags for greenwashing. The so-called misleading qualities of greenwashing, which is the third dimension, here we said that greenwashing is not necessarily an active conduct. There is an element of omission as well, and accordingly a quality of greenwashing could be, of course, misleading, outright lying, but also the so-called cherry picking, presenting only certain angles to a profile of a product to enhance one sustainability aspect or feature, which doesn't necessarily reflect the real profile of a product if we look at the whole and not only at the information that is being selected and presented to us. For what concerns the channels, of course, marketing materials, reports are the preferential channels for greenwashing, and this is understandable. However, as we move from a concept of greenwashing that is essentially pegged as a marketing practice, and we consider it as something that could occur throughout the entire value chain, also the constitutional documents of a fund product shouldn't really be overlooked in the eyes of ESMA, because this could spread as well greenwashing. Lastly, the report from ESMA adds a new dimension to greenwashing, which is greenwashing as a market risk, and with financial consequences, which is a risk that should rank similarly to any other risk and should be mitigated accordingly. If we look at media and the news of the recent past, we already saw that some financial market participants were involved in greenwashing occurrences. In these cases, there is of course a reputational risk, and these firms may lose investors in the products where greenwashing is purported to have occurred. But at the same time, there might be a ripple effect of financial nature, and the reputational risk that comes from greenwashing and it's linked to that might affect, for instance, the liquidity of the equity or the debt instruments of these entities. There might be capital misallocations at some points, and markets could stop to function orderly as a consequence to that. So greenwashing is much broader in the eyes of ESMA than a simple marketing practice aiming at deceiving consumers or investors. Bonus point we discussed was in terms of the investment management, and the report from ESMA has some interesting takeaways on the ESG tales or the ESG styles that could trigger some red flags from European authorities. One of these is the so-called engagement style. The interesting finding from the ESMA report is that for all the issuers or the fund managers that are not as evolved and mature in their ESG footprint and in their ESG identity, they might want to use engagement as an easy way to purport their sustainability identity and features of their products. And one of the ways that authorities pierce through the veil of engagement is to see whether the actual engagement that takes place with the underlying companies then basically is really followed through. There is feedback received from the underlying investee companies, and the portfolio itself in its composition is modified based on this engagement. So the engagement should be a constant dialogue that affects the design of the portfolio itself based on the behavior and the feedback from the underlying investee company with which there is engagement. There is more to come on European regulation and sustainability. If you made it up to this part of the video, I wanted to invite you to subscribe to our channel and hit like to this video. Thank you for watching. Stay tuned.